All right, say what you want about this market. It's got a real good sense of humor. Last night, we finally got some results from GameStop. Its first earnings report since the stock shot into the stratosphere. And what happens? The company did almost everything right. I mean, they delivered an impressive set of numbers. They're making some smart moves. Business is doing surprisingly well. I think it was about as good as anyone could have reasonably expected. Better! Much better than anyone imagined 3 months ago. So what happens? How much does it go up? 200, 300%? No, oh, sorry. It gets pulverized. It plummeted $61 or 34% today. Paradoxical? GameStop finds itself in a really tough position where nothing is good enough because the stock's had such an explosive move over the past few months. If this stock were still at 15, I bet it could have rallied 5, maybe even 10%. But it was at 181 going in the quarter. And that's a very different story. I don't think there was anything GameStop, the company, could have done or said to make this into a positive catalyst for the stock. Now, it doesn't really help that management's being incredibly cagey. And I'm sure those Wall Street bets guys are saying, boy, are they cagey. They didn't take any questions at the conference call. They didn't give us guidance for the full year. They stonewalled on some important issues. I think that's deliberate. Ever since GameStop became a red-hot meme stock, management has been very quiet. Like they'd rather create a sense of uncertainty, maybe it's mystique, than risk alienating their new shareholder base. It's probably a smart move. But it means you're never going to get the kind of astonishingly bullish commentary that the Wall Street bets crowd had been hoping for. I never said praying for, I said hoping for, because I am a gentleman and a scholar. Still, the actual results were pretty impressive. But before we get into specifics, let me set the scene. GameStop ascended to meme stock status in January after the brilliant, amazing, incredible Ryan Cohen, the co-founder of Chewy, bought a big chunk of stock and joined the board of directors. Cohen's the foundation of the bull thesis. You got a lot of people arguing that he can transform GameStop, look, a once beaten down video game retailer, into something with much better growth prospects because of his phenomenal track record at Chewy, which is the digital pet food kingpin. Of course, it's not totally clear what that transformation would look like. Dog food and Call of Duty. But like I could resist that one, right? But the new shareholder base does want a radical departure. So let's talk numbers. While the headline results came in a little light, in part because of COVID shutdowns in Europe, in part because they're closing underperforming stores left and right, which is really smart, there were some terrific figures under the hood. Like I said at the beginning, this was a great quarter. GameStop's, their same-store sales up 6.5%. Wall Street was only looking for 4.7. That's an incredible number, 6.5. And that's that all-important key metric. Even better, this was astonishing. E-commerce sales grew by 175%, to the point where they now account for over a third of the total, up from 12% the year before. That's the kind of transformation that the new shareholders want to see, and that is just flat-out phenomenal. Best of all, January was better than November and December, which is pretty darn spectacular. Take a bow, Ryan. Meanwhile, the company's cutting costs. Their sales, general, and administrative expenses were down a phenomenal 21% year over year in 2020, over 2020. By the way, here's what they did. They got a big de-densification initiative. Now, I got to de-densify. What a great term. Where they permanently closed 693 stores. Inventories were down 30% at the end of the year, meaning they won't have to do much discounting, non-promotional. I mean, some of them were saying it's going to be a little promotional, but I read it the other way. How about management's commentary? All right, CEO George Sherman, I thought he told a great story. Holy cow. The most important part, in February, GameStop put up 23% same-store sales growth, thanks to continued strength in the hardware sales. That's the new PlayStation and the new Xbox. 23%, that's probably the highest of any company I follow. These guys are hitting it right out of the park. But like I said before, they are still a little cagey. Management refused to give full-year guidance because the future's too murky. Instead, they basically laid out their top priorities for the year. The goal is to invest heavily in new tech. We like that. Bring in new people so that they can become a, quote, customer-obsessed technology company that delights gamers. Vague, but that's what they need to do. On top of everything else, we heard about some new hires yesterday that were shoot the lights out. GameStop's bringing in a new chief operating officer, Jenna Owens. She's a heavy hitter from Amazon, before that Google. They also hired a couple vice presidents to modernize the e-commerce and supply chain side of the business, which is already doing amazingly. One from Chewy, one from Zulily. Zulily, remember that? Z-U-L-I-L-Y? Yeah, my wife was Zulily. I got that with boxes all over the place. These are the moves you want to see. I like them. But not 210 points up like them. That's where I told you to sell it, by the way, when I had ripped out the catheter. I was in my hospital bed and called in to Carl and David and said, you got to sell it. What can I say? I mean, It's not that kind of rip out the cat third kind of move. Of course, if this company is going to deliver on Ryan Cohen's huge digital transformation, it will need to raise capital, and that means selling maybe some stock. But again, they're being cagey. You had to look through the annual report to get some clarity here. GameStop is what's known as an ATM, or at-the-market offering program. They could let them sell $100 million worth of stock. They might do that, or they might sell more than that. Basically, they made no promises. But if they don't sell some stock soon, the whole management team, maybe they belong, I don't know, maybe in a mental hospital? It's Bedlam, which is short for Bethlehem. Putting it all together, I feel much more confident about GameStop, the company, after this quarter because the quarter was that great. It made me think there's a real chance they could pull off this turnaround. And if the stock was still at 15 or even 25, I would be pounding the table right here. But as long as it's in the triple digits, it's trading like the turnaround has already happened, and management found a treasure trove of Bitcoin or maybe even Ethereum, which traded today, what, at 17? I was trading around some Ethereum today. Actually, I was buying something with Ethereum, and I didn't get it. But anyway, it trades as if they found a treasure trove of Ethereum. Now, if you buy the stock here, you're betting that Ryan Cohen's plan will be wildly successful, which seems like a stretch given that we don't even know what the plan is yet. I think that's why management's so reluctant to give us specifics. Granted, it's only been a few months, but they've got every incentive to keep us guessing. GameStop knows there's no upside in spelling out the specifics right now. This is a Maltese Falcon story. It's all about the stuff that dreams are made of. As long as they've got all these true believers in the shareholder base, there's no reason for them to paint a clearer picture. Once they settle on a plan, the plan can be criticized. You can build actual earnings models that made it possible to value the stock. Ooh, who wants that? With the stock in the triple digits, the reality of these plans will never be as good as what the Wall Street Bets crew is imagining, as great and fabulous as they are. So what's this thing really worth? Okay, Michael Pachter, yeah, I know, he doesn't like Netflix. Ed Wedbush just hit GameStop with a downgrade, even as he raised his price target from 16 to 29. Pachter's a stickler for cash flows, and he's pretty much valuing the stock like normal. At the same time, you got this Stephanie Wizink at Jefferies. She's decided that you need to value this thing like an e-commerce play. And when she does that, she can justify a $175 price target. Only the Wall Street's bets crowd would actually think that number's too low. I'm sure that's exactly what management wants to see, although we still don't know if we can pull it off. But wouldn't that be great if they did for everybody but the shorts? Wouldn't that be terrific? Let me give you another angle. Before Ryan Cohen got a seat on the board, there was an activist who got involved. His name was Kurt Wolf. He first bought GameStop in 2012, finally won some board seats early last year after an acrimonious proxy war. But here's the thing. When GameStop started spiking in January, Wolf dumped the bulk of his position between the high teens and the low 30s. That was a nice gain for him. Although if he had waited another couple of weeks, he would have had the win of a lifetime. Obviously, this guy's, though, not a true believer. And I bring that up because GameStop put together its special strategic committee earlier this month. Wolf was one of the three directors they appointed. The other two are Ryan Cohen, one of Cohen's allies. That's pretty telling. But why sell when you think that if you thought it was going to go back to 310, why would you sell some at 30? Look, here's the bottom line. I think GameStop is in an impossible position. Even when they do well, and they're doing really well right now, there's no way to satisfy the hot money guys who keep pushing the stock up to ridiculous levels. I'm much more of a believer than I was yesterday, but I also think you're taking your life in your hands if you buy the stock up here. Let it sink to the mid-double digits, then I'll get back to you. In the meantime, the man I call General Sherman is always welcome on the show. And Ryan Cohen, he can co-host with me anytime he wants. All right, much more Mad Money. Forget the Jets and the Sharks. I'm eyeing the battle between United Wholesale Mortgage and Rocket Companies. Don't miss my exclusive with the CEO of the former to find out what it means for the entire industry. Then I'm breaking down the backlash we're seeing in this market. And all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.